Hello, everyone. Welcome back to the channel. I have a big story I want to cover today. I'm sure everybody has heard of it by now, and that is the failure of Silicon Valley Bank. This is the second largest bank failure in U.S. history. Before we get into that, though, if you're new to the channel, please consider subscribing to the channel. And if you like the video, you found it informative, like the video, share it, comment, all of that helps boost us in the algorithm. So, okay, let's get into this. I published a video, if not yesterday, the day before, and I briefly brought up Silicon Valley Bank. That was literally just happening. That video was talking about other things, but I briefly touched on it there. So if you haven't watched that, maybe go watch that first and then come back and watch this. But let's just look at a graph here. This graph represents bank failures since the year 2000. You can see that the biggest one, 307 billion in losses, was Washington Mutual back in 2008. And now we have the Silicon Valley Bank, the second largest bank failure, with 209 billion. Very handy graph here just to show you these bank failures. Okay, so we're going to go ahead and look at a couple of things I have pulled up for everybody. This is the Kobayashi letter. They say economic update. This is what we're going to start out with because this pretty much sums it up. Silicon Valley Bank collapse marks the second largest bank failure in U.S. history. Total U.S. credit card debt set to cross $1 trillion with interest rates at a record of 25%, which is just nuts. If you have credit card debt, if you use credit cards, try to pay the credit card debt off as soon as possible and not use credit cards. I just don't think they're helpful. I know it's important for building credit, but what ends up happening, though, is that people kind of use them for things, basically use it to live beyond their means, and that's never a good thing. You should use credit cards very carefully and make sure that you can always pay it off right away and that you have cash to cover it. Interest rates are rising at their fastest pace in history. Mortgage demand at a 30-year low, with home prices falling at their fastest since 2011. Average new car payment is now above $800 a month. Guys, I want you to consider that we've been told for the longest time your rent should be like a quarter of your overall income, your salary. You should be able to pay your mortgage with basically 1 week's pay. And now we are at the point where just basic things that you need to survive, the cost of living has increase so rapidly, but wages are completely stagnant. So your income has not risen in accordance with the rise in the cost of living. Your salary, your income can no longer cover this stuff because it hasn't gone up as all of these other expenses have gone up. And that's not even getting into like energy costs. We'll get into that in a minute. But yeah, the average car payment now $800 a month. Guys, that is the price of a mortgage. And it's just stunning. I remember back in the day, like a car payment used to be maybe $200 a month, and then you had your insurance and stuff. And it's because you're going to spend money on gas, on maintenance as well. So that is just literally the car payment. That does not include insurance or maintenance or gas or anything else, oil changes, blah, blah, blah. So it actually is more than that. And it's just, of course, that's unsustainable. Number 6, total U.S. mortgage debt now double the 2006 peak. 37% of Americans have more credit card debt than they do savings for an emergency. This is something I covered in the prior video where I said, prepare now. Basically, everything is collapsing. The average American spending a record 46% of their income on housing payments. And again, as I said, it's generally supposed to be one week's pay should be enough to pay your mortgage, but that's no longer the case. And now it's literally half of your entire salary just to pay your mortgage. It's nuts. U.S. government debt on track to hit $50 trillion in 10 years. Unsustainable levels of debt, guys. This is a debt-run system. And we know that it's designed to be that way, to keep everybody dependent and slaves in this system, with only a few at the top that really benefit from this. Interest on U.S. debt expected to hit $1 trillion by 2033. Meanwhile, inflation has been above 5% for 21 straight months. The system is officially broken. Now, what I would say is that really the system broke in 2008, never really recovered. They came up with creative fixes for this, which was basically just printing money, and nobody was really held accountable for what happened in the last global financial crisis. Did you see any bankers getting perp walked or raided by the FBI in a pre-dawn tactical style raid like they've done to some of these, people who paraded in a 4-hour demonstration? Okay, so no, we didn't see that. The bankers never ever get held accountable for any of this stuff, and so of course they continue to do it again. They engage in the same risky, greedy behavior because they know, number one, they're not going to be held accountable. Number two, they're not going to be the ones paying for it. You are. So of course they do it again. All right, now let's talk about Silicon Valley Bank. This is a thread here from Genevieve with, I think it's Grit Capital. Silicon Valley Bank is in trouble. It sold off a $21 billion bond portfolio for a huge loss to shore up liquidity. The market is worried and stock is down 54% today. Here's what you should know. So this is coming from March 9th. This was when news first broke that, hey, there might be an issue here. I'm going to go through it anyways, though, because it just kind of lays out what happens. Silicon Valley Bank announced it completed a fire sale of its $21 billion AFS bond portfolio. The bank took a massive $1.8 billion loss on the sale. That's more than the net income of the entire company in 2021, which was $1.5 billion. Now, Silicon Valley Bank is planning to sell $2.3 billion in shares to cover the bond losses. The stock crashed 54% today for many reasons. Mainly, Silicon Valley Bank is scrambling to shore up liquidity. That's worrisome. And selling shares to potentially cover losses on investments is a huge red flag. So this is how it began. It's been a huge week in banking. Just yesterday, we heard that crypto bank Silvergate will wind down operations due to many of the same issues Silicon Valley Bank is facing, which I'll get to. Yes, exactly. So this is another bank that had a issue. How is SVB's liquidity? According to the company, they have $180 billion in available liquidity to cover $169 billion in deposits. Oof. Dilution is another reason the stock is tanking. $2.3 billion in new shares would be about 1/3 of the company at today's market cap. The stock was already down 47% year over year before today's sell-off. Why is Silicon Valley Bank selling off bonds at huge losses? The bank is facing two huge problems. The first is interest rates. SVB positioned itself horribly just before interest rates increased. The company's $21 billion bond portfolio had a yield of 1.79% and a duration of 3.6 years. Compare that to today's 3-year Treasury yield of 4.71%. Yeah, so they went and bought these bonds when they had a lower return, and now you can get them with a higher return. So why would anyone want to buy these old ones? It just doesn't make sense. So they're kind of stuck holding the bag there. As rates rose over the last year, the value of the bonds fell dramatically. Exactly. And the bank had a choice: write out the 3-year duration of its bonds with a yield far below the current Treasury rate, or sell at a loss and then reposition the portfolio to maximize yield. Basically, SVB had to decide how quickly it thought rates would decrease, and clearly they don't think rates are coming down anytime soon. Here is their plan to fix the yield problem. So they sold 21 billion fixed rate AFS securities, increased Fed cash target 4 to 8% of total deposits, reconstruct the portfolio with short duration fixed rate treasuries, and then hedge the portfolio with receive floating swaps. The other crisis that they're facing, the lagging tech market. This is huge, guys, because remember, big tech, there was a massive tech bubble that I kept pointing out back in 2019, 2020. I was writing articles and I was saying, hey, you have the tech, big tech has become 20% of the total US stock market, right? 20% is an insane number. It's kind of ridiculous. And I said, hey, I think a lot of these tech companies are massively overvalued. They're not what they once were. It's just like you cannot convince me that Apple is today worth $2 trillion. I'm just not buying it, okay? So I figured at a certain point, that's going to have to come back down to reality. And by the way, too, during the pandemic, you had people working from home. And so a lot of tech companies had a boost or a surge at that time for hiring or for their products. Like Zoom was used a lot, right? And then once people kind of got back to work, well, that dropped off, right? So that was kind of just temporary. And now we're right back to the same thing. And that's why you're seeing massive layoffs in tech. You had overbloated companies. Google was hiring engineers, not even because they needed them, just because they didn't want these people working for their competitors or something, which is just crazy. But yeah, the whole thing is a mess. So the lagging tech market. SVB is the 15th largest bank in the US in terms of assets. Now, I've heard different figures. I've heard 16th largest, 18th largest, 15th largest, whatever. It's especially popular with tech companies, as its name would suggest. Obviously, Silicon Valley Bank was used for a lot of startups, tech startups. A struggling tech market means fewer deposits in their bank. And the restricted IPO and capital markets mean that venture capital-backed tech companies have less money to deposit into banks. Exactly. SVB is facing a slew of other problems today. Moody's cut the company's credit rating and downgraded its credit outlook to negative, and tech is in trouble. They're not the only bank facing the situation. Maybe it's the first to proactively attempt to fix the problem, but the market expects more pain in the banking sector. Silvergate already announced it was closing earlier this week. And what you're going to see is contagion. You're going to see other institutions that had exposure to SVB. This is going to spread. Silvergate faced many of the same problems, but with crypto instead of tech. Silvergate's bond portfolio went sideways as well, and its customer base was hurt badly in the crypto crash of 2022. Okay, so let's move on here to the next thing. Bank balance sheets deteriorating. Unrealized losses now 620 billion, up 8 billion a year ago, which is just nuts. By the way, guys, I will include all of the links in the video description so you can go check all of the sources. Silicon Valley Bank is getting worse. Customers were trying to pull millions of dollars out and they can't. Online banking and mobile services showing unavailable for some customers. Stock market stock down 60% pre-market. If the bank fails, it will be the second largest bank failure in history, and we know, of course, that did happen. So that was on the 10th. Now, moving on. Peruvian Bull says most people don't realize how crucial Silicon Valley Bank is. Billions of dollars in venture capital, venture debt, untold amounts of warrants and convertible notes in early stage firms. If they fail, this could be a Lehman Brothers moment for the startup world. Exactly. And Peter Thiel is telling people, get your money out of that bank. Founders Fund. Yeah, that's Peter Thiel's company, one of them. Okay. Bank run on SVB might be kicking off. The one thing you don't do as a bank CEO is tell everyone, we'll be fine, just don't pull out your money. Yeah, I've worked with them through my job. They fund a huge amount of startups in the US and have their tentacles in basically every large VC and PE fund out there. Most of you have never heard of them, but in the startup world, they are huge. The real risk is SVB is essentially a commercial bank. Thousands of startups hold cash reserves there. Looks like 173 billion as of last December. Let's see. Okay, we'll move on. You can read the rest of this on your own if you want to look more into their financials. Okay, so continuing on, venture firms are advising portfolio companies to move money out of SVB, of course. Yes. Some customers are struggling to wire funds out of the bank. That was March 9th. You could just see how just in a matter of days, boom, it's done, right? This was March 10th. They drop another 60%. It's halted pressure mounting on the banking sector. They're asking, oh no, could we get bailouts? Unrealized losses. This is what we discussed earlier. Here's a thread. The sharks are circling Silicon Valley Bank. Need some of your money now. Hedge funds are offering 60 cents on the dollar in exchange for inaccessible deposits. They're such scumbags. Oh my God. Like, oh yeah, take this 40-cent loss on your money. We'll help you. The contagion that was Silicon Valley Bank is spreading globally. 180 UK tech companies are demanding the UK Chancellor Jeremy Hunt intervene. Well, they've been demanding that the Federal Reserve intervene as well. And Janet Yellen has said, no, we're not bailing out Silicon Valley Bank, but we might bail out some of the depositors, of course. Okay. Silicon Valley Bank crisis will force the Fed to slash rates by 100 basis points to prevent contagion, which is nuts. Silicon Valley Bank employees received bonuses hours before the government takeover. This was a huge, huge thing. These people knew this was coming, by the way. There were executives at Silicon Valley Bank that were selling their stock in the weeks leading up to this. So they obviously knew that something was wrong, but they didn't care. They decided to do it anyway. And that's insider trading, of course. They obviously had foreknowledge. Do we think that anybody is going to be held accountable for that? So Silicon Valley Bank, by the way, a lot of the startups that they're invested in, it's tech, biotech, things like medical innovation. They had 42 billion taken out Thursday, the day before they closed. That's what this is talking about. They're giving out bonuses. Executives were selling stocks. So you have to understand that when these things happen and you have something like a bank failure, you are not going to be protected. Your cards are going to get shut off. You're not going to have any access to your money. And we can see that you will lose your money. So it's smart I understand that you have to have some money in a bank. You have to pay bills and stuff like that, especially people running businesses. But if you can, try to have some cash on hand, just in case you can't use a card and you need to go to the store in an emergency. This is why I say have cash for an emergency. Things like that. Have several bank accounts and just have a little bit of money in some of these accounts just in case, again, for an emergency, whatever. Just don't have all of your eggs in one basket. This is criminal, though, and nobody's going to be held accountable for that. This is the same crap that they did in 2008 to 10. Thiel's Founders Fund withdrew millions from Silicon Valley Bank. Of course, he was telling people to do it. Crypto is shaken as Silicon Valley Bank risk depegs the second largest stablecoin. That was Circle's stablecoin that came unpegged. Again, hardly anybody was covering that aspect of this. Silicon Valley Bank imploded in a single day. It could be just the tip of the iceberg. I think that's true. That's coming from Yahoo Finance, blaming depositors for bank failure. This is David Zach saying that, of course, so just take it with a grain of salt. Blaming depositors for bank failure is like placing the blame for medical malpractice on patients because they didn't do a good enough job shopping for a doctor. Depositors expect the Fed to ensure that banks are safe. Okay, David. Uh, apparently, The Simpsons predicted the collapse. All right, let's check this out.
What do you mean the bank is out of money?
Insolvent? You only have enough cash for the next 3 customers! Hey, what's just a second here. No, I don't have your money here.
This is so funny. It's interesting they put that in there. You know, The Simpsons are, well, let's just say that's kind of strange.
It's in Bill's house and Fred's house.
Hey, what the hell you doing with my money in your house, Fred?
That is so funny. Bailout talk roils Washington after Silicon Valley's bank collapse. A move to make Silicon Valley Bank depositors whole without a buyer would probably require Congress to pass legislation drawing on an insurance fund paid into by all banks. Yes, which apparently does not have enough money to cover you in an emergency. Yeah. So the FDIC, they can only cover something like 1.2% of bank accounts, you know? It's just silly. And you're only insured for like $250,000 anyways. Must read thread from an innocent victim of Silicon Valley's bank collapse. Hi, I'm Lindsay, Ohio mother of 4. I employ a team of 15 as a startup founder and CEO of Strong Suit. Drive a used Honda Odyssey. Husband works in manufacturing. The financial future of my company, team, and family are at risk with the collapse of SVB. I encourage you guys to read her thread. Roku said in a filing it had around $487 million held at SVB, representing around 26% of its cash and cash equivalents as of March 10th, 2 days ago. So I have that article pulled up separately. Roku, Roblox, and others show their exposure here. This was just stunning to me, but then again, not surprising. Woke head of risk assessment at Silicon Valley Bank prioritized LGBT initiatives, including organizing a month-long Pride campaign before the bank lost billions and collapsed. So instead of actually doing her job of assessing the risk the bank was facing, she was spending her time organizing Pride parades and Pride Month at work. Some pharmaceutical and biotech companies have disclosed holdings at SVB, including Protagonist Therapeutics. So I just told you, tech, biotech, medical innovation. These were the kinds of companies that are that had accounts there. Sangmo Therapeutics, Eiger Biopharmaceuticals, and Oncorus, which said its holdings represented an estimated 23% of the company's total cash. Absolutely stunning. Silicon Valley Bank executive, you guys, you could not make this up, was previously Lehman Brothers CFO prior to the 2008 collapse. Joseph Gentile, interesting name, was previously the chief financial officer at Lehman Brothers Global Investment Bank. Oh, how nice. See, he didn't go to jail in 2008. He just went to a different bank, you know? Stablecoin USDC breaks dollar peg after firm reveals it has $3.3 billion in SVB exposure. The company revealed it has nearly 8% of its $40 billion in reserves tied up at the collapsed lender Silicon Valley Bank. Here is what the second largest bank failure in U.S. history looks like in graphics. So you can see it in graphic form, which I think is very helpful for data visualization, just so people can see the gravity of what we're talking about here and understand how serious this is and how many people can be affected by this. These things have ripple effects. Home Depot co-founder torches woke SVB collapse, warns recession may be here already. Banks are more concerned with global warming than shareholder returns, Bernie Marcus argued. He's absolutely correct. And guys, there are many of us who've been warning about this for years, okay? I've written numerous articles saying This is what I was predicting. Things like hyperinflation, global financial crisis and collapse, supply chain issues, because globalization and globalism doesn't actually work. It's not actually a good thing. It only benefits very few people at the top. Most people do not benefit from it. And generally, things don't work good. Doesn't it make more sense for you to have something a product you need manufactured locally in your area, or at least in your country? In the event that, there's some kind of conflict that happens, why would you want to rely on importing goods from other countries, some of whom are our adversaries? It doesn't make sense. Also, when you get rid of manufacturing, you're getting rid of basically the wealth of your nation, because you have to ask yourself, okay, what does America produce anymore? What do we make? What is something that's only made in America? Where's something that you really need America for, right? You could look at China and say, hey, look, all of these electronics are made in Asia or whatever. Like, they're needed for that. They're the ones, everything basically has a little sticker that says made in China on it. Where's the thing that like the USA does that other people need, right? What goods are we producing that other countries would want to buy? Ask yourself that question seriously, and seriously think about it, what the answer to it is. Just saying. The FDIC and Federal Reserve are weighing creating a fund that would allow the regulators to backstop more deposits at banks that run into trouble following Silicon Valley Bank's collapse. Of course. Democrats are working hard to ensure SVB does not get bailed out. Oh, wait, they do want them to get bailed out, is that right? They supported women, minorities, LGBT community more than any other big bank. This includes not just diverse events, but actual funding. They helped us move one step forward. Without them, we moved 2 steps back. Oh, cry about it. Regulators are offering Silicon Valley employees a 50% raise if they keep working for at least 45 more days. Oh, stay at the bank, stay here working, and we'll give you a raise. 90% of Silicon Valley Bank employees are Democrats. Oh, shocking. With 90% of their campaign contributions going to Democrats. Oh, gee, that reminds me of something called, what, FTX? Patterns. Good thing Biden has no problem breaking the law. U.S. Senator Menendez, we are not ready to offer Silicon Valley Bank a bailout by any stretch of the imagination. And so it begins. Unusual Whale says, just in, Silicon Valley Bank will reopen on Monday for insured depositors under the newly formed Deposit Insurance National Bank of Santa Clara, per Financial Times. Advice for Americans is coming in fast and furiously. Run on the bank. Get your money out. First thing on Monday, U.S. banks are in trouble. Fed emergency meeting. Deposits may get locked. Possible withdrawal limits. When markets collapse, your bank deposits that U.S. banks use to invest may be in danger. Cash is king. Get out now. That was coming from Kim.com. Hope they've got a buyer lined up. Benny Johnson says U.S. Treasury Secretary Janet Yellen rules out a bailout of SVB. While the Biden administration spends the weekend talking about how depositors deserve to lose their money, the UK is working overtime, saving British startups who did nothing wrong. Leadership is vital, and Biden is lacking, of course. So here it says the U.S. government is coordinating an emergency meeting with tech firms who are expected to call for state intervention to avoid the failure of hundreds of firms following the collapse of SVB, per The Guardian. Sources are telling me that late-stage negotiations are in the works to sell SVB to another bank. Yellen has agreed to ensure that 100% of depositors will get all of their deposits back on the condition equity holders are 100% wiped out. Very, very interesting. Continuing. FDIC auction for Silicon Valley Bank has kicked off with final bids due Sunday. Who will it be exactly? Very interesting. Okay. We have Axios, Biden on brink of banking crisis. Biden is in danger of a catastrophic banking crisis unless the U.S. government can orchestrate a deal to rescue SVB depositors before branches open tomorrow. Why it matters. Bank runs kill banks, no matter how good or bad their risk management. Oh, yeah. Well, their risk management was spending their times organizing month-long pride parades at work. So there you go. Banks don't keep deposits in a vault. They lend them out. Yeah, fractional reserve lending. They lend them out to businesses and individuals. So if depositors ask for all their money back at once, the bank will fail. They're allowed. So for every dollar you deposit, they can loan out 10 more dollars. It's just money it's magic money, guys. Funny money. Corporate America just got a stark reminder that none of their deposits are insured above $250,000 by the FDIC. No, they can only cover maybe 1.2% of all total deposits. If SVB's depositors aren't made whole by Monday morning, hundreds of billions of dollars of corporate deposits are likely to flow out of regional banks. Most would flow into a handful of so-called systemically important banks. If they're too big to fail, they won't fail. Some might go into other ultra-safe havens like treasury bills. Every non-enormous bank in America is left to worry about whether it is going to be able to hold on to its corporate customers. Investors are worried too. Shares of First Republic fell 34% last week. Signature Bank fell 38%, and PacWest down 55%. The Biden regime must find a well-capitalized buyer for their commercial business. If not, also its private bank, securities, and UK units. That would allow customers to access their money, including for meeting this week's payroll. Oh yeah, think about all the people who are waiting to get paid for their work. Think about these employees. And I know we don't like tech companies and the kinds of people that work there, but still, there are some people in these tech companies waiting for their paychecks that are dependent on them, because recall what we talked about in the last video where we're warning about this massive collapse, and to tell people to get prepared and get ready. Most Americans are living paycheck to paycheck right now. So if they can't make payroll, we're talking about potential foreclosures on homes, etc. Like, people will lose everything because they literally live paycheck to paycheck. They've got no emergency savings. So this could wipe out a lot of people, and it's not going to be the people at the top that are responsible for this. It's going to be the low-level workers. If it's unable to find a buyer, the government will come under pressure to back the uninsured deposits. That would be politically unpalatable, particularly for SVB, but it's preferable to the alternative. The FDIC is the main entity in charge. Its leadership is acutely aware the best way to avoid bank runs is to signal that everybody with money there will get access to it. Treasury and the White House also have a role to play by removing regulatory obstacles to SVB being immediately acquired by someone like, JP Morgan or Goldman Sachs. Yeah, great idea. During the Great Financial Crisis, the Federal Reserve guaranteed corporate transaction accounts under something called the Transaction Account Guarantee Program that expired at the end of 2012. TAG. Oh, notice how there was nothing created for you. The Federal Reserve didn't guarantee your money or your homes when, we had this massive homeless crisis in 2008 to 10. Had TAG or something similar been in place last week, SVB might still be alive today, and thousands of companies wouldn't now be worrying about their financial solvency. All right, so let's continue. Bottom line, look around the world, and nearly all countries are dominated by 3 or 4 banks. The U.S., with its thousands of banks, is an outlier. The FDIC's job is to shore up confidence in every last one of those banks. Oh, yeah. Right. Okay, so Here is an article from Market Sentiment. How did you go bankrupt? 2 ways, gradually, then suddenly. I thought that was kind of funny. Every banker knows that if he has to prove he is worthy of credit, in fact, his credit is gone. Indeed. Okay, so the first 2 are easy to grasp. So number 1, the odds that you'll get hit, the average consequences of getting hit, the tail end consequences of getting hit. Yes. Okay, so the odds are that you will be caught low if you're not wearing your seatbelt. And even if you're caught, the fines that you end up paying are not too much. But the tail end risk of getting into an accident while you're not wearing a seatbelt, even though it has an extremely low probability, is all that should matter. SVB's 48-hour collapse, resulting in the second largest failure of a financial institution in the history of the United States, was a tail end risk that none of us saw coming. People at SVB saw it coming in the weeks prior because they were selling off stock and giving themselves bonuses. And who's going to investigate that? Is there going to be an investigation into who knew what and when at SVB? I'd like to know. SVB provided financing for almost half of the VC-backed startups in the United States, and the company had more than $200 billion in assets and $175 billion in deposits at the time of its collapse. This is also deeply personal to us, as SVB was the de facto bank recommended to us when we started Market Sentiment, their publication. In a stroke of extreme luck, they denied our application as we were bootstrapped. Haha. How does the bank work? So, contrary to popular belief, banks do not keep the money that you deposit in your checking account. They lend it out to other people at a higher APR and then pocket the difference as profit. Fractional reserve banking. It's just nonsensical. How much they can lend out is based on the reserve ratio set by the Fed. If a bank has $1 billion in customer deposits and a reserve ratio of 10%, they're only expected to hold $100 million in their accounts. The remaining $900 million they can lend out to other people. This is why if there's a bank run, you're not going to get all of your money back because they don't keep it. They lend it out. The money that was lent out, again, goes into other banks, and the cycle repeats. The benefits of this system are apparent. You can cycle the same money through the economy multiple times and just magically create stuff, and credit access becomes easier without creating additional money. The problem of the system is also apparent. It puts banks at constant risk of runs. What if all the customers return simultaneously and ask for their money back? Forget all customers. If more than 10% of the depositors demand their money in one go, you have a problem. The government and Fed have multiple safeguards to prevent this. First and foremost is the deposit insurance. The FDIC, which insures up to $250,000. So if there is a bank run, you'll at least get that. If you had that, if you had more than that, well. 2020 and 2021 were incredible years for Silicon Valley Bank. Because of the pandemic. The record low interest rates, the crypto and Web3 boom, tech IPOs, SPACs, and VCs are writing a check for every other growth company. We're all strong tailwinds for a bank that works exclusively with startups. Deposits in SVB grew from $60 billion in 2019 to over $189 billion in 2022. So their demand ballooned with the tech boom and then fell as startups struggled. One critical problem for that bank is that unlike traditional banks that work with big companies, there aren't as many credit-worthy startup customers to whom they can lend money. Exacerbating the problem was Silicon Valley was swimming in cash during 2020 and 2021, and none of the startups wanted to take a high-interest loan. Even though they tried their best and increased loans by 100% to $66 billion, they still had far too much capital in their accounts and wanted to deploy. SVB bought $80 billion in mortgage-backed securities with an average yield of 1.5%. While it does look extremely foolish now, at the time, interest rates were near zero, and the Fed's projected interest rate was 0.1% for 2023. So they just didn't know. SVB's trouble began with the Fed raising interest rates at the fastest pace we've seen in recent history to try to contain inflation. The rate hikes were a triple blow to Silicon Valley Bank. So they've got it's a convergence of things happening at once. With every rate hike, the $80 billion they had locked up went down in value. A 1.5% yield might look attractive when the interest rates are 0%, but with Fed rates approaching 5%, the bonds had a drastic drop in value. The bank had market-to-market losses of $15.9 billion as of Q3 2022. With the end of zero interest periods, growth stocks started dropping like flies. IPOs dried up and VC funding became non-existent. That meant the inflow of new deposits became a trickle, which exclusively catered to startups at this bank. To make things worse, deposits started to fall. Companies started withdrawing as they're not getting any new funding, and cash burn was increasing, given the higher inflation and lower customer demand. Investors were already aware of the increased stress on the bank. To fund the redemptions, SVB sold $21 billion bond portfolio Wednesday, forcing them to realize a $1.8 billion loss as their portfolio was yielding an average of 1.79%, far below the current 10-year Treasury yield of about 3.9%. Just the next day, SVB announced they were also selling $2.25 billion in common equity and preferred convertible stock to fill its funding hole. This was a really bad move. The market was already spooked by the collapse of Silvergate Bank, and SVB announced a raise with a press release that all numbers and no narrative. The company made no mention of why it was raising money and how it was planning to use it to strengthen its balance sheet and how strong its financial position was. This spooked a lot of founders who had almost all their cash with SVB, and VCs jumped in to advise founders get their money out as soon as possible, triggering a bank run as customers tried to remove $42 billion from the bank in literally one day. That's crazy. Okay, so let's move on. Just to note, though, when Washington Mutual failed in 2008, all deposits were transferred to JP Morgan, which acquired Washington Mutual for $1.9 billion. No one lost any money that was deposited in Washington Mutual Bank, and no deposit insurance was used. It would probably be a scenario like this, where FDIC arranges a sale by Monday and depositors are made whole by the end of the week. There's too much riding on this for the FDIC or Fed to risk not returning the money, because companies wouldn't be able to make payroll, and it would trigger an extinction level event for startups and U.S. companies, which just would not be good, and they know that. Traders brace for more market shocks after week of wild swings. As one threat recedes, another takes its place. At Morgan Stanley, recession trade was widespread with clients, of course. Bank runs, stiffening Federal Reserve resolve against inflation, credit risk, and the risk of recession. This article is from just yesterday. Investors absorbed a lot of the shocks the last few days. Shaking them off all at once may be impossible. For hairy traders, the problem is that one threat recedes and then another takes its place. The economy is too hot or at risk of being gutted by financial stress. One day, bond yields surge as inflation anxiety spirals. The next day plummet as the travails of lenders convince everyone the Fed will step back. The result has been increasingly wild moves across the spectrum of asset classes, swings that may persist over another news-packed stretch. Yeah, so basically no one knows what's going on, and so everything's crazy. In a week featuring the biggest U.S. bank failure in more than a decade and a stock drop eclipsing any in 5 months, the most jarring event may have been in treasuries, where yields saw their biggest two-day plunge since the financial crisis. Rate traumas like that have a habit of forcing speculative money into evasive action, particularly in an economy where Fed angst made short bonds a popular trade. Okay, so moving on, Barron says Silicon Valley Bank has fallen. What happens to its RIA and advisors? Good question. They'll all be fine. Brex CEO is trying to raise over $1 billion in a weekend for SVB related bridge loans. So he's a startup founder trying to raise money because he had his money tied up there. Ad tech firm in Canada has over 90% of its cash tied up in Silicon Valley Bank. Of course it does, because why wouldn't it? Total assets of failed U.S. banks by year. Oof. 2023 figure shows total assets of Silicon Valley Bank. Yikes. Is Silicon Bank the first of many? That's the question. U.S. commercial bank deposits percentage off of high. Very weird. This was the article. Roku, Roblox, Etsy among companies impacted by SVB collapse. So these are all these tech companies, all these startups, blah, blah, blah. Space company, Vimeo. Okay, so let's move on. Silicon Valley Bank employees receive bonuses hours before the government takeover. Unreal, guys. It's absolutely ridiculous. Where were the bank supervisors? Banks almost never get taken over during business hours. A $200 billion bank should not fail because of liquidity, says the former head of the Boston Fed. He said they should have been sold last weekend. Yeah, isn't that nice? Stablecoin falls below the dollar, faces $3.3 billion exposure to Silicon Valley Bank. So what we're seeing here is that this is just the beginning, probably, of a ripple effect that will continue and reach other institutions that had major exposure to SVB. And again, it is the second largest bank failure in U.S. history, the prior one being Washington Mutual in 2008, during the 2008 financial crisis. So anyways, I'm interested in hearing your thoughts on this. What do you think about Silicon Valley Bank? What do you think about the bank failing? What are your thoughts on Silvergate, crypto, and all the other crazy stuff we've seen in the past year?